All right, we are live. Let's get all the tech on board. Looks like I got the socials. All right, let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagerin. Hey, Doug.
Hey, Kirk. Good to be here. Unlike other things, I haven't melted.
Well, just cross my fingers. My ice rink hasn't melted either. So,
Well, I hate to break it to you, it's coming because we're getting almost 50 in Minnesota, and you're a couple days behind us on that heat wave. So,
nah, we're good. We still got some. It's still cold at night. It's still in the single digits at night, but next week we're going to see like the low 30s. So, yeah.
Hey, you know what? Cold at night. That means like you basically have a built-in Zamboni, right? It'll thaw a little bit during the day, kind of smooth in those grooves, and then next morning.
If it was only that easy, Doug. That's not how it works. No, you got to flood it. You got to put water down, which, water costs money, Doug. But yeah, you got to put some water down, layer it at night, make it nice and clean, and shovel it off and do all the stuff. Yeah, it is not easy to maintain.
Too much damn work. You just need a pond around here and just shovel it off and play.
Yeah, and then the ponds get all messy too. It's tough. This has been a tough winter for the rink, I have to say. I mean, we've had a lot of ice time, but like people have been sick, so we haven't really used it as much as we normally do. But whatever, it is what it is. But anyway, on to more important things. I don't know what to talk about today, Doug. Like nothing's going on in the markets. Like, have you noticed anything? Like, I don't know what's going on.
everything out there is just underwhelming. I feel like maybe a little deflated. I don't know. Got any ideas?
Yeah, I think I could probably find a few. Yeah. So last live was on Monday, which we recapped the Friday meltdown of the precious metal sector and end of crypto. Pretty much every day, with the exception of today, crypto's melting down. It's kind of getting close to the point where we're like, maybe we can find a bottom soon. I don't know. I'm not sure we're there yet, but I think for sure a lot of people have been liquidated, I think is the term they're used.
The late jumpers are feeling the pain right now. The early jumpers are still doing really, really nicely and, are well ahead. But yeah, if you jumped in, we talked about this 6 months ago, get in early. If you jumped in recently, it's a little painful.
Well, this is why you have to stay on top of things. This is why you have to get early, because when you get on late, like if you got into precious metals in January, you saw they were up like 100 some odd for silver, and gold was whatever it was, 70 or 80%, and the miners were up 100 some odd percent. If you saw that, you're like, oh, I got to get in. And then January, we're like, woohoo, this is great, everything's great, until the last day of January, we're like, oh crap. And this is the fear. This is why the market. And I was saying this to somebody last night, and I think it's important to say it here. The markets operate on fear and greed. Those are the two emotions that dictate market behaviors of every single person in the market. Now, when you get to a point where there is no fear, it's only greed. And I would say precious metals were hitting that, because they pretty much went straight up in September, took a breather, went straight up in December and January, and then they fell apart the last day of January. That is greed. There was no fear in the market at that point. People kept parroting the narratives of, the central banks and there's manipulation and blah, 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 blah. Okay, whatever. The point is when you see that, when there's only greed and there's no fear, that's a problem. Now you might say, why is it a problem? It kept going up. It's a problem because that's not how markets operate, right? It's any force needs a counter force, right? Every action needs a reaction. You can't only have one side, because if you only have one side, then you want to buy gold. Gold's at $1 million a price because no one wants to sell. You need buyers and sellers. Fear is the sellers. Greed is the buyers, generally speaking, right? So you need both, or you have these huge spikes up in price. Somebody called the silver price the Burj Al Khalifa. It's like, yeah, that's a pretty good accurate depiction. Went straight up, then straight down. But in reality, you need both sides. And I know no one wants to hear this because everyone wants to make money. But you make money on both sides if you're smart, right? I'm not suggesting you short. I would suggest actually nobody's short. Even the best shorters in the world are bad at it. So it's not something I would suggest you do. But my point is there's always somebody making money. It's usually off you if you don't know what you're doing. So what you want to understand is if there's way too much greed, you might want to step aside a little bit. If there's way too much fear, maybe you want to wade into the waters, right? You need to see those extremes. If you see those extremes, that's when you want to make a decision of, you know what? I have a thesis. Our thesis we've been talking about last year, gold, silver, going higher. There's a thesis behind that. And it worked. And then things went crazy. And I was expecting it to some degree, not to that extent, but to some degree, I was expecting some sort of, push up, and then it would have a blow off top, and then it would settle down, everybody'd leave, it would quiet down, and then people start accumulating again. I expect that. I still expect that. I still think we're in a precious metals bull market. We're just having a very big break. And it could be a year or two before it moves higher again. Just to be clear, I mean, that doesn't mean we're in a bear market. It just means that we had a huge run up and we need to work that off. In a normal functioning market, I would expect the precious metals to go sideways for the next year or two. That would be my expectation in a normal bull market. Now, if they spike back up, I would say it's still unhealthy because there's still a lot of energy there that needs to dissipate. So what you want to see in a healthy market is, and I'll actually use this as an example if I can pull it up here. Let's see if I can find it here. All right, so let's look at crypto. Let's look at Bitcoin. This will be a fun chart. We're going to look at, okay, here we go. Let's look at this. Pull this up, share this, blah, 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 replace. There we go. Okay. So here is Bitcoin. Okay. This is the weekly chart. Now, if you look at Bitcoin, it went up and then it went down. And it just, as you can see here, it went down and it just kind of went sideways, a little down, but basically sideways for a few months. Then it went up, then it went down, and then it stayed down for really better part of a year. And it went up a little bit. It was basically, I call this kind of like sideways. So it kind of went sideways for about a year. Now, if you look at Ethereum, is even better chart. It went up, then it goes down, and it just kind of, it went down and it went up, but it kind of stayed here. So this action right here is what we call burning off the momentum. So you see this, that's a lot of energy and hopium. We like to call it hopium here. Hopium pushes this up. And then people realize we're being stupid, and then the institutions get involved and they start shorting this and they start pushing it down. And then people freak out, and then everybody leaves and they say, I'm never going to do this ever again. And then it starts to go up again, and people get involved, and then the hopium kicks in. So this is a cycle. Crypto is an exaggerated part of this cycle. That's why I'm showing it. But when you see this, this was a good time to get in. Actually, this is a good time to get in. The end of the year, people were selling off because of tax loss selling. I actually looked at this and got in at the end of the year because I looked at it and said, this is cheap. I think the intrinsic value was like 2,400 and it was 1,200. It was like, this is a no-brainer. But, that was a calculation. If I was wrong and it kept going down, I would have just sold out. But it turned out it was right. And I've been wrong before, but this is an example of what you'd look for. You say, all right, it's burned off. End of the year tax loss selling, pushing it down, perfect time to take a position. And then it kind of still went sideways for a while, but then it started to take off. Okay. And so you want to look for these times where you have this extended sideways movement, because that's where this stuff burns off, that energy burns off. And then you get a natural progression higher. Now, if you look at, let's say gold, for instance, gold goes through these, although not to the same extent, but let's look at gold prices. Now look at this. Gold hit the bottom right around the 99. So this is kind of a bad chart. But I wish this was logarithmic. I'll see if I can figure that out. But if you can look at this, right? Audio viewers, bear with me. Gold bottomed in about 1999, and then it went up. and it kept going up until 2011, and then it fell off right around 2013, and then it went sideways for years. It bottomed between 2013 and it bottomed 2016 and kind of came back 2019. Didn't start really going up till 2019. Then it went up a lot. Then it went sideways from 2020 until about 2023 at the end. Then it spiked. So it goes through these periods of sideways movements, which burn off that energy. Okay. Now, gold's a little bit more mild, right? You see silver. Look at this. Silver spiked up in that same period, 2009 to 2011, and then it spiked down, and it went sideways pretty much from 2015 until right around 2024. That's 9 years of sideways movement, and I'm being generous on the sideways movement. But point being is it worked off that energy. This energy is going to take some time to burn off. Now, fortunately, we're still in a bull market for precious metals, so while it's burning off, it might take a year or two, but if it goes higher after this, I would be very cautious. Now, it could keep going higher. I want to be clear. It could go up to 200, 300, 400 bucks an ounce, and it could just go straight up. That's possible. I'm not saying it will. I'm not expecting it will. I actually think that would be highly unlikely. But let's say that happens. Okay, but it's not a healthy move. Things don't just rocket up 400% in a year and then they just flatten out. That doesn't happen. That's just not how markets work, right? Markets are buyers and sellers. So if you don't have that fear, if you don't have that fear in there, then effectively you don't have a healthy market. So what I'm suggesting is the last week has been a tad bit crazy. If you weren't paying attention, don't start paying attention now. That's all I'm going to say. But if you look at the last week, you had tech and crypto, especially software, got obliterated, got just mauled. You got big tech with earnings that came out. Amazon is down 12% for the week. Microsoft was down 11% after earnings. Nvidia's down, Google's down, Meta's down for the week, even though it was up, I think, after earnings, but down for the week. Apple's about the only big tech FANG that's up. And I don't know why it's up because it hasn't increased its earnings or profits in the last 3.5 years. But regardless, if you look at, and I'll bring this up because I think it'd be helpful to share, and then we can just dive into other stuff. So here's the weekly chart heat map, as people call it. So this is what's happened in the last week. Okay. Technology software completely crushed. Software applications crushed. Semiconductors, they're late to the party. They're just starting to get crushed. But if you look at IGV, which is software, I mean, look at this. It peaked out in November, 117. Now it's at 82. It's gotten completely crushed. But if you look at the semiconductors, they're just kind of hanging out. They're not really feeling it yet. But you know what you need to run semiconductors? Software. So, I think the AI bubble seems to be popping. I'm not sure if it is, but it definitely feels like it's starting. But we'll find out later. Palantir came out with earnings, didn't look good. But so my point is, you look at all these tech areas, they don't look good. If you look at the other areas, though, what is doing well? Well, financials did well. I'm not sure I'd stick with them long term, but they did well. If you look at healthcare did great. Healthcare did great. Consumer defensive, consumer staples. Wow, look at consumer staples. They did pretty well. Industrials have been doing well. Industrials are doing great. Energy's been doing well. But look at all these things. These are all doing well. Tech's not. So why are you in tech? That should be the question in your mind. We just had a meltdown in tech. We had a meltdown in software, which is still going on. We had a meltdown in crypto, which we have a reprieve today, but it's I don't see it letting up. We could get a bounce here for sure, but it's gotten crushed in the last week. So you have all these things happening, right? The speculative assets that are getting crushed, and these other assets are doing great. So what's your takeaway? If your takeaway is, yeah, but now tech's cheaper, I can go buy it, then you're missing my point. This is not a buy the dip environment. I know we've had one for the last like 20 years. Buy the dip, buy the dip, buy the dip. I get it. That's worked for 20 years. Doesn't mean it's going to continue to work. No, it is not a rule that always happens. You do not always buy the dip. Buying the dip works if you're in a bull market. If you're not in a bull market, you're basically lighting money on fire, because buying the dip turns into a bigger dip. So if you're in a bull market, buying the dip works. If you're in a bear market, what they call, the term that Wall Street uses, is sell the rip. So if the stock's going down and then you get a bounce, you sell the bounce, you sell the stock at the bounce, and then you're shorting it down, and then you buy it back, and then you do it again. That's what we call selling the rip or shorting the market. I don't do that. I don't suggest you do that. But that's how you should be thinking about the markets, right? Even if you're not doing it, in your mind, you should be thinking this is a good time to sell. Like I said, I don't do it. I don't think it's wise. It's very hard to short markets, but you should be aware that this is going on. So looking at this market, what you should be thinking is, well, tech's not doing very well. We're in a weak period in tech. NASDAQ has been underperforming. What should I be doing? Well, asset managers are not doing well. There's reasons for that. But all these other areas, what should you be doing? I'd stay away from financials. But healthcare, industrials, consumer staples, energy, utilities, these are all doing fine. So what you should be looking at is, if things are ugly and the markets look ugly, what is doing well in an ugly market? Those are areas you should pay attention to. Now, not only will they lose less when the market's going down, but they might even make money, which is what you're seeing this week. With a terrible week in earnings, you're seeing some great numbers from all these other companies. You should be paying attention to these companies. That's where your head should be right now. How do I make money when the market's going down? How do I make sure I lose less? Look at these areas. So this is how you should be looking at the market this week. I know everyone was looking at it from this lens up here in the technology sector, and they're like, oh my God, the world's ending. No, the world's not ending. Just technology. Now, I'm going to say this, and I'll hand it back to Doug because I don't want to monopolize the whole thing. Think of the market as think of it as a pool or a pond, right? There's a certain amount of water in the pond. Now, the water is going to go where it's going to go, right? However, if you take a big bucket, let's say it's a small pond, you take a big bucket that has no water in it, it's empty, and you push down anywhere in the pond, what's going to happen? The water rises in other areas, right? Because you have the same amount of water. So all you're doing is you're pushing it down one area, you're pushing it up in other areas. That's how the markets work. And that water is what we call liquidity or money, right? Money is in the markets. It has to go somewhere. It goes to stocks or it goes to bonds. If it's in stocks, which sector does it go to? Out of the sectors, which stock does it go to? All these things matter. But if money is flowing out of tech, where's it going? Well, obviously, it's going to every other sector. It's not going to communications, it's not going to discretionary, it's not going to tech, it's not going to semis, it's not going to software. It's going to staples, industrials, utilities, energy, healthcare. That's where it's going. So knowing that, you should be looking at repositioning portfolios around that trend. Now, what do all these areas that I just mentioned have in common? They're all typically in value stock portfolios. So you might notice, if you haven't, you'll notice now, that the NASDAQ this year is, it might be up. I don't know. It's down. The NASDAQ's down for the year still. It was down a lot yesterday. It was down like 3%. Now it's down maybe less than 1% for the year. Okay. How's the Russell doing? Well, I'll tell you, the Russell's up 7% for the year, maybe more. Hard to tell from this chart, but let's say 7% for the year. Okay. What's going on? Where, and I don't have the AW value. Let's see, let me bring up the Russell value. That's the one I was looking for. Here's value stocks for the year. Straight up, last month, this month, they just keep going up. This value stocks. You want to look at growth stocks? What are growth stocks doing? IWF. Growth stocks are down, just going straight down. You should be looking at this. This is important. This is a deviation from what has happened up till now. Value stocks are doing well, growth stocks are not. What are all these areas have in common? They are value stock areas. So if you're not hearing anywhere else, you're hearing it first. This is what we've been talking about for a while, and we're going to keep talking about this for a while because I think this trend is going to be an enduring trend. We are going to be focused more on this new trend and less in the areas you want to hear about, like crypto and metals. We'll talk about metals if they're important, but I'm paying a lot less attention to metals right now. The areas I'm paying attention to are the boring sectors, low beta sectors, sectors of value. Those are the ones doing well. International, that's doing well. Why are we going to focus on things that aren't doing well? Focus on the things that are doing well. So I'm a positive guy. I like to focus on positive areas, and you should with your investments. So I know I just dumped a lot on you, Doug. Give us some thoughts. It's been an interesting week.
So if I heard you correctly, you're just throwing all your money into the boring company?
Not the boring company.
Actually, I don't think you can actually. I don't think you can actually invest in it yet. That's a joke on Elon Musk's.
Yeah,
company.
We love you, Elon.
The boring
please
company,
don't,
correct?
Please don't
yeah,
mix us.
Exactly. So one thing I love that I kind of heard you say, you talked about Palantir, and I just have to say this really with a touch of irony. Palantir's earnings missed, and I find that very ironic for a company built on predicting everything except their own revenue growth.
That's a good joke, Joe. I hadn't thought of that. That's pretty funny.
Yeah, just a thought. It's hard. When your product is seeing the future, the market's going to expect you to see your own earnings coming. I'm just saying. Just details. Listen, I want to say a couple things that I think are in line with what you said, and some things that might counter a little bit, just a little bit of balance here. As you mentioned, I mean, the risk, the markets have definitely been a risk off mode. There's the sell everything sentiment. Right now, global markets aren't just soft; they're actually breaking down in multiple asset classes. And you mentioned several, stocks, crypto, even metals have seen heavy, selling pressure. And that's sparking a talk of a broad risk unwind as investors kind of reevaluate that exposure. This is not random. It's a sentimental shift, not just individual asset weaknesses. And then when, thing is risk, assets decorrelate from hope and start pricing in real stress. It can tell us markets are looking for that liquidity and safety that you're talking about, not just growth stories. You mentioned for year to date, S&P 500 is now negative for 2026. The job market's going to add to those worries. It's now that it's fallen into negative territory for the year. That's driven by a broad sector weakness, deteriorating labor market signals, layoffs and shrinking job openings. Those job openings are the lowest in years, and that's leading to rising volatility. Why is this critical? It's because the markets have been pricing a resilient economy. So as you get into soft job data, that's going to undermine that narrative. Another reason why value, defensive, again, putting a little bit more credibility behind what you just said. And it raises the question now, is a soft landing real? They've been talking about this forever. Or are we just going to continue to face a longer trend of slower growth? Going back to the layoffs, we're seeing a lot more everywhere, but specifically tech, crypto declines, things like that, the impact of AI, the broader economy. Crypto exchanges like Gemini, they cut 25% of the staff amid a Bitcoin slump. Major tech and corporate layoffs have tracked across dozens of industries. There's a record January job cuts that we have not seen since 2009. I don't know if you remember this, Kirk, but 2009 wasn't exactly the greatest economical situation. So, there's definitely opened some eyes there. By the way, completely off that tangent, but MicroStrategy now, which again is one of the biggest buyers, and this of course is going to, I saw this week. When you think about crypto becoming something that might get adopted even at a national treasury level, one of the things when you start to see more and more of that being, assumed or collected under one company like MicroStrategy, that again, that's not a good thing. That actually pushes away entities from wanting to get more involved because of that, because of that holding. But right now, he's significantly underwater, and it's starting to get into a dangerous territory for them. Coming back to the layoffs, these aren't isolated to one sector; they're widespread. And it's not just AI disruption. I know we're hearing a lot more about that, but it's economic recalibration. And that pressures income, consumer spending, and housing demand, which those become significant headwinds on the economy. If I come back to crypto, the stress continues. Bitcoin up a little bit today, but it has slumped significantly. The price pressure, I don't think it's over. I think large drawdowns and reevaluation of crypto as a risk asset continue. I think the opportunity for it to be this, this incredible, asset of growth, those days are over. It's going to be volatile, but you're not going to expect the same returns as we got before. They're going to start getting smaller and smaller. As it gets bigger and bigger, think of how much it needs to move just to make that growth. By the way, I've said this before, if you bought Bitcoin and you actually hold tangible Bitcoin, not an ETF, and you bought it and it's down, you can sell it today and buy it back today and capture those in. So there's a little tax planning from Uncle Dougie. For big monetary policy shifts, the new Fed chair, again, this may not reverse the sentiment. It's like it's behaving like high beta risk assets. It's not necessarily an independent store of value. That impacts broader risk sentiment and portfolio psychology. We're also starting to see a greater correlation. So it's now about 0.5 correlation to the S&P 500. That has been a trend that has been continuing. If it continue, I'm not sure if it's going to continue to go that way, but it's something to note. It's starting to bounce as opposed to an asset that's non-correlated. It's becoming more and more correlated to the markets, and that's something you might need to just expect. Coming back to big tech, you wrote about that. It definitely hasn't been immune. The shares of these major companies like Amazon, surprisingly, which did well, but the shares slumped after announcing huge capex plans. Such as a $200 billion AI build-out. Investors are starting to question whether the AI spending boom is going to be sustainable or replicative of past bubbles like the dot-com. Mega spending is not guaranteed returns. We know this about investors. They don't like to hear about spending at all. Companies cannot invest for months, years, decades like they used to. Mega spending spooks markets. If earnings can't immediately justify it, that's a problem. And that feeds into sector rotation, risk-free pricing. And lastly, global central banks and rate signals. Beyond the U.S. Fed, major central banks like the Bank of England have been showing a hesitancy on rate moves with very narrow votes and markets increasingly pricing in future cuts. So if central banks shift to accommodation prematurely, that signals a worry. It's more defensive. It's not offensive policy making. Now, the one thing I do, counter is in just a quick summary before I hand that back, from some data that's come out there, from some indicators that I follow and things that I look at from a quantitative trend analysis to move exposure in and out of equities. Yes, the S&P 500 has declined. About 4% over the last week. NASDAQ about 8% down. That's a significant snapback. But despite that, there still seems to be, indicative of a technically positive. And that means in some of these systems, those pullbacks should be viewed more as a potentially viable rather than outright breakdowns. But yet, like Kirk, you're saying, be cautious. And that doesn't mean just jump in. Really know what you're getting into. The volatility index, the VIX, currently shows to be oversold. That's historically a signal of higher probability of stabilization after short-term risk sell-offs. Yes, Bitcoin almost 40% down in 10 trading days. That behavior is not uncommon for its volatility. So again, if you're going to be into it, we've said this, just be willing to have the stomach to do so. This is not the wonderful guaranteed future $1 million Bitcoin value that people sell it as. You may get there, but you're going to have to ride some very sharp turbulence on that ride. Gold sharp drop has contributed to stock selling pressure underlying the cross-asset stress and how that can feed equity risk behavior. But on a macro front, labor market data such as weekly jobless claims near cycle lows and stronger manufacturing growth, still show underlying economic expansion signals, even as these markets wobble. So, in summary, I think it reflects that what many systematic trends are still showing is that technical deterioration isn't necessarily a structural breakdown. It's a momentum shift. That's again, be cautious what you jump into, be cautious how quickly you jump into, but so far there doesn't seem to be anything that's indicating that we're going to fall into a massive free fall. So, if anything, we might be hitting a period of stability again. Hello?
Sorry, I was muted there. So, if you look to Doug's point, I mean, if you look at kind of what's happened in crypto, for example, this is normal. I know no one likes to think it's normal, but it is. There are certain expectations you should have when you invest in crypto. One is that it can go down 70% and that it could go up a few 100%. People kind of ignore the fact it goes down 70% because they're just like, whatever, I'll just write it out. No, you won't. You're gonna. I have to say the memes this week on X about crypto have been absolutely hilarious. And we might try to put stuff up on the website here because they're just hilariously funny. But the reality is like it's a feature of crypto. It's not a bug. It's a feature. Goes down 70, goes up a few 100%. Over time, that volatility should be shrinking. The only reason people invest in it is because of this volatility. Let's be frank. Are people using Bitcoin to exchange for coffee? No, they're not. Yeah, I know there are some crypto, lifers that will do that. I have a friend who does that. But everyone else isn't doing that. Why? Because it's not practical. It's not something we use in our day-to-day basis. We don't have a crypto wallet that we go and buy stuff at the store. It's just not happening. Now, it may happen at some point, but it's not happening now. Why are people buying it? Because they're speculating. They think it's going to go up, or they think it's going to go to the moon, or to the moon, as they say. Okay. So if you understand the cycles of crypto, it's really easy to invest in. I say invest in air quotes or pseudo investing. You wait till it gets crushed. It's down 70%. No one wants any part of it. People don't want to talk about it. The volatility's low. It's just getting ignored. Everyone's like, I'm done with this. When that happens, it's a great time to buy it. And when it starts going up, then you start to accumulate into the position you want. And then you just ride it out. Goes up a few 100%. But you have to wait until the volatility is completely squeezed out of it. Right now, there's a lot of volatility in there. Actually, today, a lot has come out. I was looking at it. I don't have this on my thing I can share, but in one of the things, if you look at volatility yesterday it went up to 90. And in comparison, the VIX, which is the volatility for the S&P 500, went up to 80 during COVID. That is the highest it's been that I'm aware of. Went up to 80 during COVID. It went up to 90. Bitcoin and volatility went up to 90 yesterday. Okay. Before that, it was in the 50s. And today it's back down to it's 58. So you want to wait till the volatility just doesn't exist, because then people are ignoring it and they're not interested in it. People get involved because of the volatility because they can make lots of money in the volatility. Now, you and I don't, because it's not the game we play. But Wall Street, they make tons of money on the volatility. And part of the reason why it goes down so much is because of the volatility. People short it. They say, hey, I can make a lot of money by selling volatility here. I won't get into the weeds of all that because it's a little bit highly complicated. But in general, just understand that when things get crazy, when the volatility picks up, it's a good time to step aside. You don't want to be around for that, because that's when the Wall Street titans start fighting with each other, and you want to be out of that swimming pool when that happens. So anyway, so what I want to point out, I want to kind of go a little bit further down the road I was talking about, and it's this. So I'm going to share some of these with you so we'll be on the same page. All right. So here's here's a list. I found this from somebody. I thought it was generally a good list with some exceptions. Here's a list of things that were doing well up till the end of January. Small caps, energy, materials, staples, industrials, consumer discretionary, semiconductors, alternative energy, including nuclear, aerospace and defense, spin-offs in space, commodities, especially energies and precious metals, and stocks outside the US. What I'm going to highlight is this, because some of these are probably no longer going to be the hot areas. Small caps should be fine. Staples, industrials, consumer staples, not sure if staples, aerospace and defense, seem to go in a lot of wars. Stocks outside the US, so international stocks, and nuclear is a question mark because nuclear falls in the metals space. But I think those are the areas that I would be looking at right now. And I am looking at those. I think those areas are going to continue to do well this year. Everything else, it's unclear. We could have a flush in the system where tech goes down like 40% and then pops back. We could have that. I doubt it, but it could happen. But at the moment, everyone else is just like, whatever, we're just buying tech. We're just going to buy the dip. Okay, at some point that stuff's working. But here's something I want to bring up, okay? And I'm bringing it up for a very specific reason, because I was looking at how can we, if I assume tech's going to get crushed and the NASDAQ is largely tech, maybe I should sell the NASDAQ, right? Or short the NASDAQ, okay? And I'm just going through this thought experiment to help you guys understand how to think about things. So I was going to short the NASDAQ. And what I did is I looked at the sectors. How is the NASDAQ split up? Well, it's 63% technology. All right, well, that's a good start. I thought it was more like 80, but okay, 63. Consumer discretionary, it's like 18%. Healthcare's 5, industrials, okay, it's a lot less. But basically, you're looking at technology, consumer discretionary, and healthcare. Okay, well, those are important things. All right, well, what's next? What else do we look at? Well, next we look at what are the top holdings. Okay, top holdings for NASDAQ. Oh, I'm sorry. This is the wrong one. Let me pull this up. Sorry, that's a start of a joke from Blazing Saddles. Let me whip this out. All right, Q Holdings. Here we go. All right, so top holdings of this are. Here we go. Sorry, I had some dead air there. All right, so here they are. Top holdings. Oh, crap. Sorry. Got too many charts here. Here we go. All right. So here are the top holdings of the NASDAQ. NVIDIA, 8.3%. Apple, 8.1%. Microsoft, 5.8%. Okay. Amazon, 4.75%. Meta, just under 4%. Alphabet, combined around 7%. Tesla, okay. Wow, that's a lot. That's a good start, right? And very few of those have done well through earnings so far. Tesla. Oh, look, Walmart. Wait, what's Walmart doing in the NASDAQ? Why is that there? Well, okay. All right. Well, that's Walmart. That's 3%. Broadcom. Without having to go through all the rigmarole here, let's go through some more. Okay. What's after Broadcom? Costco. What are they doing in the NASDAQ? Well, there you go. That's something to think about. Keep going. Lots of tech. Pepsi. Pepsi's in there. Huh. Okay. Keep going. Amgen, Gilead, Intuitive Surgical, Honeywell. Wow. There's a lot of non-tech in there. Now, it's mostly tech. I mean, let's be honest. It's mostly tech. But when you really break it down, as we kind of bring it back to where we were before, like how many holdings are tech and how many are non-tech? Well, I just can't. You got stuff all over the place here. But 63% is tech and just under 18% is consumer discretionary. Well, here's the problem. When you think that tech's going down, and it does, and then the NASDAQ is only down a few percent, kind of makes you scratch your head like, what's going on? Why is the NASDAQ not down more? Well, it's because consumer discretionary, that part of the NASDAQ, is actually doing quite well. And so is Apple for some odd reason, and Meta for some odd reason. So when you're thinking of shorting an index, this is the kind of process you have to go through. And I just went through some very superficial part. There's more you'd have to do. But that would be part of the process. Say, wow, this should have done worse. Why is so the Nasdaq at the moment is down? Well, as of yesterday, it was not down further than we were in December. December was lower than we are now, or we were yesterday. What? We had all these bad earnings in December, spiked down worse. How's that possible? So, sometimes when you think you have the right thesis, i.e., shorten the Nasdaq because software has been going down for months, and we figured semis were going to catch up, and they started to. But the reality is, when you look at this, you're like, wait a minute, what's going on? What am I missing? Well, it's because the holdings are aligned in such a way so that even though some things are getting crushed, everything else is holding steady. So the Nasdaq should have been down maybe like 15%, maybe 10. Instead, it's down like 6. So just keep that in mind with your thesis, is that you really have to have a full scope of understanding. Don't just, push buttons and say, oh, it's in the right direction. You have to really sift through like why things are happening, because it actually surprised me. I was very surprised at what I found in this, and I was sure that it was higher tech, and have come to find out it wasn't. But when you look at, and I'm just going to give you a second primer here. Now, if you look at a comparison, this is the Staples index. This would be the XLP. This is if you look at the S&P 500, these are the top staples. Walmart is almost 12% of that index. Costco, 9%. Procter & Gamble, 7.5%. Coca-Cola, 6.25%. Philip Morris, just under 6%. You look at all these top ones, you're like, these have been out of favor for a long time. Imagine for a moment, let's just have a little thought experiment. All the money that's in tech, right? You have 7 stocks that have 30 to 40% of the S&P 500 index. I mean, that's just crazy. 8 stocks, I think, of 40%. So if 8 stocks have 40% of the S&P 500, then those 8 stocks should dictate performance of the indexes quite heavily. Now, let's say tech is dead. Let's hypothetically say tech is dead and it goes nowhere for the next 5 years. Okay. Or let's say it gets crushed and it goes nowhere. Remember the tech bubble bursting? Tech went nowhere for like 15 years. Microsoft in 2014 had gone nowhere. It actually kept getting better and better value because the company kept getting better, but the stock price went nowhere. So when you look at something like that, like, all right, what if we have dead money in tech for like 10 years? Where's the money going to go? This is where it's going to go. It's going to go into staples, go in utilities, going to go in industrials, go in healthcare. It's going to go all those boring stocks that we never talk about. And you know what? They're started last year, and it's continuing. So if you're looking for areas to invest in, you should be looking at areas that are doing well when everything else is doing poorly, because that means that the money's flowing there, which means that smarter people than you and I see that the opportunity is to invest in those areas. So that's the simple way to look at these things. And this is just the top 10. This is the top 10. There's a lot more here, but these are the top 10. I would say the top 10 here make up about 20, 30, 40, we'll call it 50%, right around 50%. These top holdings right there of the whole index. So something to keep in mind, something to look at. We're not going to go through all the sectors, but if you're really taking your investing seriously, this is the kind of thing you should be looking at. No, we're not getting too much in the weeds because we don't have the time, but this is how you should be thinking about things right now. You should be looking at what are the opportunities. Don't look at buying the dip. Don't look at, oh wow, Bitcoin's cheap. Let me just buy the dip all the way down. Yeah, you could buy it all the way down to zero. You're going to lose a ton of money. Believe me, I've done it early in my career. I love junior mining stocks. They're like a lit match soaked in kerosene next to a nuclear weapon. Okay, they are next to crypto is the only thing more volatile than junior miners, and I'm not even sure that's true. So early in my career, I bought them all the way down because they were in a bull market, and then they kept going down. I'm like, oh, it's a better value, and they just kept going down. Trust me, don't do that. Okay, you don't want to buy in the dip all the way down. There's a certain point where you stop buying the dip. You want to wait until the volatility comes out and wait till things are flat. We're not there yet for the hot sectors like metals or crypto. I'm not saying crypto's not going to bounce. I just wouldn't touch it. It's just not. I would stay away for the moment. I would wait until there's a better risk reward setup. But if you're that person who's sucked into the hype of all the stuff that's cheap, oh, look how cheap it is. It can get cheaper. I got a joke for you. Okay, never heard this. Doug hasn't heard this. What do you call a stock that's down 90%? What do you think, Doug?
A stock that's down 90%. I don't know, Kirk.
It's actually a stock that's down 80% and then fell in half. So So do the math, right? A stock that goes from 100 to 10, if the stock goes down to 20, if you lose 50% from 20, it goes to 10. So from 80 to 10 is a 50% loss, or an 80 to 90 is a 50% loss. It can keep going. That's my point. When you do the math, you realize how quickly you lose money on the downside. Don't do that. It is very easy to do, especially if you're a value investor like myself. If you want to buy the dip, you want to buy stuff cheap, it's really easy to get sucked into that. You have to, contain your urges to buy something just because the price is lower. I'm not saying it's not a good idea to buy stuff when it's lower. I'm just saying you got to be careful. So I would rather buy things that are going up than things that are going down. Things are going up or getting better. Things are going down or getting worse. So in this market, you got to look for things that are doing well. Where's the money flowing? In the boring stocks. It's flown away from tech. So you should be focused on the boring stuff because that is what's doing well. Now we'll get into that more this year because I think the trend's going to continue and I think it's going to go a lot further and people expect. So consider yourself early. Last year was really early. You're still early. People aren't talking about this yet, but they will. Trust us. We'll be talking about it all year. And by September, people are like, oh my God, look at this. It's doing well. I'm like, yeah, we've been in it all year. So you're hearing it first or second if you heard it somewhere else, but you're definitely in the early side. So I would be very closely paying attention to these sectors and do your homework, look around, find, low risk areas, low risk ways to get involved. But that's what we're doing right now. I'll tell you, we're seeing a ton of opportunities. So what are your thoughts, Doug?
Well, I think two things. First of all, I think a really good example of what you're saying regarding safe, getting away from tech, getting into safety in the last couple of weeks is a good example is waste management, right? This is a stock, and I'm not telling any people to jump into or anything, but just comparison for correlation.
Boring, Doug. It's boring
It
stuff.
is boring. It is absolutely boring. It is the correlation between waste management and the NASDAQ is extremely low. A 1 means they're exactly the same. The correlation between these two is 0.25 to 0.45. And waste management tends to rise in market stress and fall during normal conditions. And ultimately, what does it provide? Essential services, regulated pricing, contractual cash flows, volume tied to population basic economic activity. How about what is the NASDAQ? Although there are some weird ones in there, as you noted, that don't reflect because everybody thinks NASDAQ's just tech. And so, it's funny to see that in the index is very surprising. Now you'll see that in mutual funds a lot, where a manager will throw something that's out of left field that has nothing to do with its core benchmark, because they're trying to pad their returns or reduce volatility. And that's when one of the ways you could, if anybody's still in mutual funds, which there still is a lot of volume there, that is one way you'll see kind of a questionable manager, is how true they are staying to the asset class. But NASDAQ is generally running off growth expectations, rates, liquidity, earnings duration, risk appetite. Waste management doesn't need optimism. The NASDAQ does. Rising rates are going to hurt NASDAQ multiples. Waste management, they'll just pass through those costs. They'll just maintain their margins. They benefit from inflation, actually, in a way that tech generally doesn't. And that creates diversion in rate-driven markets, which we are absolutely in. Stress correlation to normal correlation. Key for normal markets, the correlation is going to stay low. In panic or liquidation events, correlation tends to spike temporarily, but after stress, it falls again. Waste management is going to behave more like a portfolio stabilizer, not an uncorrelated asset. And in practice, When the Nasdaq rallies hard, you're going to see a waste management lag. Boring, as you said. But when Nasdaq sells off, as it has this year, waste management not only held, but it actually, it can, actually rise or at least decline less. In an inflationary environment, waste management can absolutely perform. They don't need to worry about it. They've already got established infrastructure. They're not borrowing, and they're going to charge you more. And then those charges are going to be sticky. They're going to charge you a higher delivery fee just to pay for the gas to get those trucks out there. And I assure you that delivery fee will be more than the gas they're actually paying. In risk-off rotations, waste management's going to attract more capital. So that's not coincidence. It's a defensive capital rotation. So, waste management and Nasdaq don't move together because they don't answer the same forces. And that's what we're talking about here. That low correlation is exactly why defensive cash flow assets are going to matter more when markets rotate. The other thing I want to talk about a little bit is thinking in the aspect of January effect, because we just came out of January, and it's historically a market anomaly where often small cap and beaten down stocks have tended to outperform because you get tax loss selling that has run its course at the end of the year. You get portfolio manager rebalance, and you get investors rotating back into risk after year-end outflows. It's a statistical anomaly. It's not a guaranteed anomaly. Now let's talk about 2026. Has it happened this year? Well, we saw some broad market declines happen in January. We saw many risk assets correct rather than ripping higher. And we saw small caps lag, large caps. And then we saw this precious metal sell-off. That is not the classic January effect script. In fact, the markets so far have behaved more like a mean reversion, a risk repricing, than a seasonal inflow. And so these recent sell-offs are pushing volatility higher. Small caps haven't caught up. Breadth remains weak. So from an annual kind of, again, looking at ways to look at the market, January effect did not show up strongly this year in its usual way. So what does that mean for the full year outlook? Seasonal patterns are going to be less reliable now. In a high volatility regime shift market, inflation noise, rate uncertainty, geopolitical tension, policy shifts, seasonal effects can often be overwhelmed by macro drivers. If anything, the January weakness could set up a counter seasonal behavior. So when we saw that weakness in January, some years have actually seen stronger returns later in the year as fundamental drivers reassert themselves once technical oversold conditions resolve. But listen, do not assume a payoff just because the January was soft. Seasonal statistics are statistical tendencies. Nothing we talk about is rules. And in 2026, macro and liquid conditions look like they're going to matter more. You got to look at inflation expectations. You're going to have to look at rate policy with this new Fed chair dynamics. You're going to have to look at the breadth and risk appetite and look beyond America into global economic data. Those forces are going to outweigh a typical seasonal momentum. Let's look at that from a bullish standpoint. For the rest of the year, weak January could be a setup for rotation if economic data stabilizes, institutional rotation into value, as you mentioned, or financials, although caution, small caps if risk pricing improved. By the way, I want to come back to the financials. One of the reasons to stay cautious, financial organizations as a whole are still facing major headwinds, both in terms of interest rate issues, but also self-imposed because of some of their terrible decision-making on asset acquisition. And a lot of, especially major banks, for example, and even insurance companies, as you're facing hurricanes and a lot of other issues that have led to some losses in property and casualty, those remain headwinds on the financial side of things. And inflation data surprises to the downside, while real earnings stay resilient. Those are bullish cases. Now coming back to bearish cases the rest of the year. Risk repricing could continue from January into Q2 and even into Q3. Breadth fails to improve. That means leadership remains concentrated, and continued policy uncertainty. You've got the Fed, you've got midterms coming up, you got fiscal deficits. That's going to keep volatility potentially elevated. Most likely, at least I see markets chop and they start to, digest January weakness. I see sector rotation replacing uniform gain, like you do, and then sentiment remains fragile with bursts of strength. So let's not get rid of, let's not go into this with a view of imminent crash, but let's also not go into this with a view that we're going to get boom. I think there's too much regime uncertainty out there right now.
Yeah. No, I think that's good sentiments. Let's, in the interest of time here, let's wrap it up, Doug. Where can people find about you?
Listen, as we take a look at what's going on with everything out there, and we start to really get a view of all of the uncertainty that's at play, and we start to get into a situation of an additional impactful type of rotation where you have to really be wise and think about the things that you're holding. I think now is going to be a time to, the message is really consistent. This is not a market for rigid, passive thinking. We're in a rotational environment. Red charts don't automatically mean panic. Green signals aren't going to tell you it's all clear. What it tells us is that structure is going to matter more than conviction, and asset rotation is going to beat set it and forget it when these regimes change. Where does that come back to you personally? Well, that's why income planning for your future, for retirement, for goal, for distribution, especially as we're starting to see again more homeowners. The average age, 14% of homes are owned by people over the age of 75. People are aging in America. We're not Japan, but we've got Gen X coming on the cusp of starting to turn from accumulation to distribution. Income planning, thinking about how you're going to get that back out and how it's going to be supplemented. That needs guardrails. When trends weaken, income money needs to stay conservative. Growth capital, you're going to need to stay flexible. And money tied to real obligations like college or near-term spending, that cannot be left exposed to bad timing. If you're an affluent family, especially, the complexity is now your risk. Families that struggle aren't going to be underinvested. It's going to be misalignment. They're not going to necessarily have a picture of how assets they've accumulated or income that they're trying to take or taxes that they'll pay, embedded or realized now. College funding, protection, all that fits together. Who's going to win? Those with clarity. So before chasing returns or reacting to headlines, it's critical you begin to see the full picture. What each dollar is supposed to do, what can rotate, what must be protected. And that's how you're going to make smart decisions in volatile markets without guessing. So if today's conversation between Kirk and I felt familiar, that's your signal. Visit mergentadvisors.net. That's my website, MERGENT, mergentadvisors.net. Once again, MERGENT, to learn how to map it out, stress test it, and build a plan that's going to hold up whether these markets correct, inflation lingers, or policy shifts again. Because markets, they're always going to rotate, but the noise is going to fade. And the plans with clarity and guardrails, they will be the ones that endure.
Awesome. Well, thanks for coming on, Doug. And that's the show for this week. Thanks again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here in the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.